Okay, here we are. We're here. I've got this sorted finally. Figured out how to use it. I've just tested, and the microphone quality isn't the best, but it's not horrendous. So you'll just have to make do. Um, Basically, what I'm going to be covering is everything you see here. So this is what I look for every day. Um, this is the step-by-step criteria I follow. It's super simple. Yeah, I think you have an understanding of liquidity. Um, Displacement you might be a little unsure on, but I'm going to show you all of this anyway. Market structure shifts, you have obviously covered fair value gaps. Um, this is just some extra pieces down here as well. So like stop loss placement, how much you're going to be risking, um, handles, you might not know what that means, so I'll go over that as well. Um, where you kind of target with this model, like where's appropriate to target, where's appropriate to take partial profits as well. These are some extras, so asset correlation. I'm not going to go over this too much today because I don't want to deep dive it too much, but ES showing similar price action is favourable. Um, this is the key time, so between 9:45 and 10:15 New York Standard Time, which is 2:45 p.m. to 3:15 p.m. UK time. That's kind of when I look to take entries. It might be slightly before 9:45, but the macro is 9:50 to 10:10. I think I've discussed this with you before. That's a 20-minute window where price has an algorithmic shift to hunt liquidity, and a lot more volume comes into the market in that 20-minute window. And we'll go over this as well when I get into the example. So this is the time frame I look to take trades. Red folder news on Forex Factory. TGR does cover this in the bootcamp. Not sure if he's covered it yet, but I think I've told you before as well. Where I check news is called Forex Factory. So, in fact, I'll quickly just do this. If it wants to load, just go forexfactory.com, create an account, and this is what it looks like. Up here, what you want to have selected is only the USD currency, and high impact, which is the red folder, and medium impact, which is the orange folder. This will show you all the news that's going on. And what I do every Sunday, I look at the week ahead, see what times the news is dropping, and plan my trading around that. If we've got high impact at 10 o'clock, so let us try find one as an example. Here, Tuesday this week, we had PMI at 9:45 a.m. This is red folder, this is high impact news, so I'll wait for 9:45 to pass by, wait for the news to drop, and I'll start taking trades after that and see if there's any setups. That's covered that. So first thing we want to cover, you know what liquidity sweeps are, but there's certain types of liquidity sweeps that are more important than others. So London and Asia highs and lows, these are really clean and important points of liquidity. This is the high or the low that gets put in during that session. And what the market likes to do is refer to those points in price. And sometimes, a lot of the time, you can get some really nice reversals, which is how I trade. So London and Asia high, there's a tool as well in the indicators that I use to mark this out. So if I wanted to go down into the charts, this is the example I'm going to be showing you today. I think you've seen this example. I've showed you a screenshot. I took the trade a little bit differently, but this is the model that you should be following and that I do tend to follow. See this little icon here? If you click this, well, it'll not show for you, but it does for me. This is what I use to mark out my sessions. So if you zoom out, come down, you can see this is London session. This green box is all of London's trading. This box here is Asia, so this is all of Asia's trading. So you mark out the high and the low of each session. So for London as well, you mark out the high, which is TP3 here in this example, and the low, which I've marked out London low here. If you want to find this, just press, I'm going to press escape. If you go to indicators, then if you search ICT sessions and kill zones, this one, I believe, no, it's not actually, it's this here by Vince FXBT. Just search this into your indicators and then you can have it up as well. I use this every morning, just plot out the highs and the lows. But yeah, anyway, what I was going to get into is, first of all, you wanted to talk about order blocks because you weren't too sure about order blocks. So to make it simple, I've made some examples of bullish scenarios and bearish scenarios, and I'll go down onto the charts and show you what it actually looks like with candles as well. But basically, an order block, say this is a bullish example, so prices came down, we've came into a higher time frame fair value gap, maybe a daily fair value gap. We've traded higher, lower low, higher high. This leg up here is a bullish leg. There might be some down close candles within this leg, but obviously it's went up, so the majority of these candles are going to be bullish. So for an order block, you would draw it out. I was telling you last night, I use lines, not blocks. You could use a block. You could do something like this. See, this is a green candle, this whole block. You draw out the block like that, and price comes down into the block and then expands higher. Say we have some sort of buy side liquidity here, or like an external target. That's like what the setup would look like. So order block, we come up, we go lower, we go higher. If price retraces, we want to see this area here, particularly the highest point of it, offer support. The highest point of an order block is the most sensitive. So the opening price and also the wick. Say we have a little wick on this candle. Let me just show you an example because it's going to be easier. So here, I can see one straight away. This area here. So we trade up, we take out some sort of buy side liquidity over here. We trade down, we come higher, we trade down again, higher, we come down. This level here, should I say this one, is an order block. See this green candle? Price comes down, we trade through it, and then if I wanted to see price continue lower, I would expect this order block to be treated as resistance to send price lower. So what do we do on the next candle that forms? We open here, we trade up, we tap into the order block, and we trade lower and lower, as you can see. Again, another example. I'll just go along, find some examples for you. What do we have? This is a bullish scenario, so just disregard all this stuff. Don't pay attention to this. See here, we trade higher, we come lower, higher again. And look at this candle here. Let me draw this out. This bearish series of candles is a bullish order block. So the way TGR explains it is through this, I believe. Now, as you can see, that just like clogs up the chart a lot, and it takes up a lot of real estate on the screen. So I don't use that. Like I say, I just use a line. But you can see here as well, we trade up higher. If price wants to come down, I expect this level to offer support to continue higher. As you can see, when you come onto ICT, you learn about how the market is algorithmic. It's an algorithm, it's code. We come down, we tap the order block to the tick, like precisely. We tap the order block, you can see, and expand higher. So that's an example of a bullish order block. I hope that makes sense. Just keep rewatching this if you don't understand, and you will pick it up eventually, like I was explaining before. So bearish order block as well. I did show you an example of that. See, we trade higher into some kind of higher time frame PD array. We trade lower, we come higher, we come lower again. If we continue higher, I want to see this level offer resistance to send price lower. Say we have some sort of sell side target down here. Price trades through. Then what I'm seeing in my head is I'm identifying this here. And as soon as I see price start to come back, slowly candles are forming, bullish candles are forming. I want to see this point offer resistance. As you can see, I know I've drew it out, but I've just showed you an example in the chart. It sends price lower. So if you're in a trade, you look for these signatures, or you can actually take trades off order blocks. See, you were in short here, or you were looking to sell because you have a sell side liquidity target down here. Let's see, we'll come into this fair value gap. We're staying in the lower half, which is a sign of lower prices. Price is not willing to go higher, so this is offering resistance lower. So we come lower, higher, lower. This level here as well is an order block. Boom, we draw that out. Let me label this order block. Let's get rid of this for now. You could take a trade off this. If you have conviction that price is going to go lower and you have other concepts or confluences alongside it, you could just go, alright, I'm going to go short of this order block, have my stop loss at consequent encroachment of this fair value gap or just above this, pardon me, swing high. Then you could go, right, okay, I'm targeting that sell side. That could be a trade. I know loads of people that take trades just purely off order blocks. But personally, I don't do that. I'm going to get into how I trade. You've kind of got an idea already. But moving on from order blocks, I think that's covered. I've tried my best to explain. Obviously, like I say, watch TGR, see what he says. Watch other people, Justin Whelan, ICT. You'll pick everything up from ICT. But that's order blocks. That's all I'm going to cover today. Now, breakers, similar to order blocks. It's a pattern in price you need to remember, and you'll become familiar, it'll become second nature when you're watching it form in real time. A bullish breaker, the way it works is, first of all, you need a low, a high, a lower low, and a higher high. That is a complete bullish breaker. I was showing you yesterday as well a sign of a bearish breaker. So here, high, low, higher high, lower low. I sent you a screenshot yesterday. It doesn't look exactly like this, but the candles do the same thing. It's a bit choppier, but it's still, the point still stands. The breaker is still valid. So this is how I trade basically. I look for a breaker all the time. We come in, see we're trading lower, we're trading lower. We'll come into some sort of higher time frame PD array. Come into like a daily fair value gap. We stay in the upper half. That's a sign of strength in the Nasdaq. We've already put in a low, a high. We've created the lower low. Now I'm waiting for a higher high to be created. That means these series of up close candles need to close above this high. If they don't, it's not a valid breaker. It's not a breaker block. You need these candles to go higher than this swing high. Okay. And then what you want to do to take an entry off a breaker block, I was telling you about the unicorn model. Price retraces into the breaker block. In the best case scenario, if you wanted to take a trade, the highest probability trade would be when there's a fair value gap resting in the breaker block. So if I just label this fair value gap, this leg up creates a fair value gap. We come back, retrace into the box, the breaker and the fair value gap. I'm thinking, right, okay, this is a high probability trade. I'm slapping this long, stop loss, below the breaker, target, buy side liquidity. Okay, that's essentially, in a nutshell, how I trade. Now, I've got a perfect example of this below on the chart. I'm going to quickly cover stop loss placement as well. I was telling you, if we go back to the notes I've got, max risk is 20 handles. Now, 20 handles, one handle, see these numbers here. See, for example, we've got 25,060. For one handle, it'll be 25,061. 25,062 would be another handle. So every number higher, so every one is one handle or 1 point. Some people say handles, I say points as well. It's an interchangeable word. So when look at my cursor, see the numbers on the right hand side. There's a point, there's a point, there's a point higher, there's a point higher. So from 60 to 70, that's 10 points or 10 handles. All right. So when I'm taking trades, I want a max risk of 20 handles. That's how I trade. That's how the majority of people trade. Some people do 30, some people do 25, but for me, I like 20. So you can see stop is 20 there, but I would have my stop, see this number here, 16. I would have my number around there, around 16 handles. It's below the breaker block. The reason I have it there is because I don't want price to come down below and stop me out. If that happens, then I'm clearly offside. I've got the wrong idea. Price didn't want to go higher. But if it does want to go higher, I anticipate this area and price not even being traded to, and we get a nice strong reaction higher off the top of the fair value gap in the breaker block. All right. Again, if you don't understand that, I might be speaking a bit too fast. It's the first time I'm doing this, so just give me, be a bit patient with us. But I think you should be able to grasp that concept. Now, a bearish breaker. Again, I showed you an example on WhatsApp last night. Didn't look as clean as this, but this is what I look for every day. Say we take out some sort of buy side liquidity here, and we get a reversal. So let me just quickly draw out here. Say this is a liquidity level, buy side. All these here, by the way, you create these yourself. These are like presets, so it's easy to just mark up the chart. You'll come to do that later on. Obviously, it's not necessary right now. So say we take out some sort of buy side liquidity. Say London high is here. I'm like, okay, boom, London high has been taken. I'm now looking for a reversal of London high, and this is the pattern I look for. So a high gets put in, a low, a higher high, and then a lower low. The only way this breaker is valid is if these series of consecutive down close candles close below this swing low. If these candles come down and don't stop, and they stop below the swing low, that's not a breaker block. You need these candles to come lower, below this low. That then creates a valid breaker block. As well, I was telling you, just like on this side, we would ideally look for a fair value gap within the breaker, ideally the lower half when it's a bearish breaker, or the upper half if it's a bullish breaker, like this. Something like that. Okay. So we come down. Then at this point here, I'm saying to myself in my head, okay, boom, I want price to come up. And if we come up, I want to take a short off this. Okay, I want to take a short position and target this sell side liquidity here. Stops above the breaker, because I'm not wanting price to come through this fair value gap and inverse it and through the breaker. If I'm on side, price should just dump from this area. Okay, so I hope that makes sense. Just remember the pattern for bullish and bearish. A bullish pattern is low, high, lower low, higher high. Bearish, high, low, higher high, lower low. Once that's happened, you then look and wait for a retracement into the breaker again. So retracement, retracement. You've got a fair value gap in the upper half for a bullish scenario. You've got a fair value gap in the lower half for a bearish scenario. When price comes back into this point, you want to take a short position to your point of interest. So this could be London low, could be Asia low, could be previous day low or previous day, well, not high, it'll be previous day low. Okay, that's breaker blocks. Now, have I got any other examples? No. All right, so let's go into the charts now. Don't know where this example is. Bear with me. Okay, here we go. So I actually took this trade and I'll just run you through what we have. So I'm going to go on to an hourly time frame here. Bear with us. My computer is quite slow, I've noticed. It's obviously like a really bad computer. But anyway, this is the hourly time frame, okay? So before these candles, none of this, from this point onwards, none of this was here, okay? It was this low was put in, and that was it. So when we respected this fair value gap, I drew this out, went down onto a lower chart. Bear with me, bear with me. You have to go back so far. Just bear with us, sorry. It's been very slow. Jesus Christ. Right, here we are, finally. So that's the hourly fair value gap I drew on the hourly chart, okay? Also, what I do, like I explained before at the beginning, I mark out, using this indicator, the highs and the lows between my sessions, okay? So this is the low of London session. This whole green box, this was the lowest point in price, okay? Same with Asia. This, wherever the low is, here, that's the lowest point in Asia. That would be called Asia low. This would be called Asia high because it's the highest point within the trading session of Asia, okay? So I mark that out every day. Before 9:30 happens, this is all marked out, ready to go, okay? So I'll turn this off, it's a bit distracting. So what do? This is 9:30 here, okay? This candle is 9:30. This is when the market opens, okay? So what do? We trade lower off the open. We take out London low, okay? So London low, okay? We take that out, we sweep liquidity. So on my checklist, that's the first thing I look for, all right? A sweep of liquidity. I've sent you this PDF. What's the first thing we look for? Sweep of liquidity, okay? Buy side or sell side, could be London or Asia or some sort of external liquidity. What do we sweep in this scenario? We sweep London, okay? London low is swept. Now, what's the next step? We look for displacement in the opposite direction. Displacement is a very strong push either higher or lower, okay? So in this scenario, we want to buy, okay? So this is a long position. So after we take out sell side, I want displacement higher, all right? While doing that, that displacement leg higher, what does it create? Now, if I take this off, and I take this off, you can see we put in a low, a high, lower low, higher high. Remember what I said, this is a valid breaker because this swing high gets broken through. Low, high, lower low, higher high. So what do? The way I draw my breakers is like this, wick to wick, draw that out in time. Boom. That's a breaker block right there. All right. So I'm going to label that a bullish breaker. These lines in the middle of the boxes, this is called consequent encroachment. I've told you about this before. You'll learn this with ICT, but just remember, consequent encroachment is the midpoint. Look how we respect the midpoint and we stay in the upper half of the breaker. that's a sign of bullish order flow. Now, when looking at the chart, can you see a fair value gap? I can. Can you point it? I'm not going to point it out, but can you see the fair value gap in the breaker block? Fair value gap is a 3-candle pattern. 1, 2, 3. Look at the gap between. This is a fair value gap. Draw that out. Boom. FVG. There you go. So this is my model to a T. This is an amazing trade. People made absolute fortunes of this. It was, I mean, from the entry to the exit, 110 points. That's a lot. So right at this point here, I was already in the trade, but for the sake of the model, when we get to this point, I'm thinking, right, okay, we've got a breaker, we've got a fair value gap, the unicorn model has presented itself. I'm now waiting for price to trade back down into either the breaker or the fair value gap or both. Whichever one gets touched first, I'm taking a long straight off that. Okay, so what do we actually come back and do first? The fair value gap. I'll be like, okay, boom, I want to go long straight off this. I want to target London High. Remember, this was actually London High. If I put my indicator back on, you can see this is the highest point of the green box. All right, this is London High. A key point in liquidity. That's why that's a good TP. And that's what it looks like. Okay, TP1 will be here. So this is where I take off the bulk of my position. See, I'm trading 3 contracts. I know you don't understand contracts yet, but you will come to learn. It's very simple, very easy. Most of my position will come off here. My stop loss, which was down here, was actually more like here. 24 handles, which isn't bad. Once we hit this swing high, I'll then move my stop loss to break even and take partial profits. So what am I doing there? I'm paying myself as the trader, I'm secure run profits, and then I'm making the trade risk-free by moving my stop to break even. Because if the trade traded up here and then just went straight down to my stop loss, I won't lose any more money and I've secured some profits at this swing high. But that doesn't happen. Price continues to trade higher. Relative equal highs. All these highs are really equal. It's really smooth. ICT teaches smooth edges like to be made jagged. Okay, smooth edges like to be made jagged. What does that mean? When you have loads of smooth edges, meaning equal highs, this is all very smooth. Look at my cursor. They're all on the same sort of length, like height. They're all the same kind of height. This is relatively equal, sorry. So what does the market like to do? When you have relative equal highs, it likes to take them out. Okay, it likes to hunt liquidity and take out relative equal highs. So what does it do? It takes out relative equal highs. That will be TP2. So you're trading 6 contracts. You can take 4 contracts off here. That's the bulk of your position. Move your stop loss to break even. Then you've got 2 remaining contracts left. You can have 1 for here and 1 for here. Final TP. Right. So I think that's all I'm going to cover, to be honest. That's my model. That's what I look for every day. It doesn't happen every day though. It's not happening at all this week. So it's a very high probability model. I've researched 1 year worth of data every single day for 1 year. This has got an 83% win rate, which is extremely high. That's like really, really good. Most people's win rate is on average 50-60%. So an 83% win rate, if you just trade this model solely, just trade this model by itself, you'll be profitable. It might be a bit overwhelming at first, all this information I've told you. Like I say, rewatch it, but you'll get the idea, okay? We'll go back over to here again. I've just discussed partial profits. Most of your position, either 50% or the 80%, comes off. Then you reduce risk, that would be your TP1. Entries inside the macro, I didn't cover that. What time do I enter the trade? 9:56. This is, I'm going to mark out 9:45. Okay, I'll do it in black so you can see it a bit better. Oh, it is in black, I'll just turn the opacity down, sorry. Okay. There's 9:45, where's 10:15? Boom. So in this time window, the macro I was talking to you about, when price likes to seek liquidity, what's it done? Exactly what I just said. It seeked liquidity. Okay. So this is where most of the trades happen. The best trades happen within this time window. If not, you could do the last macro I trade is 10:45 to 11:15. If there's no setups between this and that time, I just don't trade. Pardon me. Okay, so we're in the time window, so it's valid for that reason. It's valid because we've swept liquidity. It's valid because we've got displacement. It's valid because we've got a breaker block, low, high, lower low, higher high, boom, retrace, fair value gap. Look at that rocket ship. Straight, it's like textbook. These patterns you'll become familiar with. Low, high, low, low, high, high. Bearish scenario, high, low. Oh shit, sorry, that's auto block. High, low, higher, high, lower, low. Do you know what I mean? Boom. And that's all it is. It's very simple. So just focus on this, rewatch it a few times. This is going to take up way too much storage on my computer, so I'm going to end it there. Hopefully you can still hear us. I'm going to edit the video and I'll send it to you. I'll find a way to send it. Alright. See you later.